Okay, good evening, class, and welcome to our advanced taxation class. If my memory serves me right, the last time we learned about taxation of business income, and we talked about the part one, which is the basis period, and we spoke about the basis period of sole proprietorship, partnership, and companies. Today we'll be moving to part two, which is taxation of business income, capital allowances. Now, these are the very fundamental basics of taxation. Now, without knowing basis period and capital allowance, you cannot solve taxation problems. More especially, this topic called pioneer legislation or pioneer businesses. It draws from your knowledge of basis period and capital allowances. And so it's a good thing now that we are learning it as if it was a basic taxation class. Okay, so now let's take a look at what the capital allowances entails here. Now, normally, profits are charged after a business is concluded. And we said last time that profits, taxes are charged based on profits that are made via preceding year. So it means that if you make profits, let's say your accounting year ends in December of every year, and we are in 2020, it means the tax you are going to be charged upon will be based on profits derived for the year ended 2019 December. Then what is capital allowance? Capital allowance is that claim to the profit for any non-current assets that you put into the business. So that asset that you put into the business is a chargeable asset. It is claimed against the profit you make in any given year. In other words, the government is saying, if you put any asset into the business, it's a big investment you've made. The government is willing to allow you recoup all that investment before you start paying tax. But the government is saying, okay, no, we will not say we'll wait until you recoup everything before you start paying tax. You are going to recoup certain amount, certain percentage of that asset from your profit. Then as you recoup some, we are going to take profit from the remaining parts. Now that's how capital allowance works. Now, you must have heard about capital allowance being 2/3 of accessible profit. Or some people will say capital allowance is 66 to 3% of accessible profit. Sorry, one of the rules here is please don't on your video. Don't on your video, like this person that's on this video is distracting me. Please don't on your video, don't on your audio. It's a bit distracting. Now you've heard about capital allowance being 2/3 of accessible profits. Now what happens is that Let's assume your assessable profit is 99,000. Let's assume your assessable profit is 99,000. 1/3 of it is 33,000. 2/3 of it is 66,000. Right? It means if you divide your profit into 3 equal parts, 2 parts will be used to claim capital allowance. Now that's very generous on the part of the government. 1/3 will be used to cater for your taxes. So it's so generous. Also, the government is willing to forego their rights of collecting tax whenever you have capital allowances to be claimed. So you see, capital allowance is a very important thing. And so the government, knowing that this is a claim against what you are supposed to pay as tax, they are very keen in you computing the capital allowance in the correct way. Now, if you look at the screen here, you can see some of the capital allowance rates. You can see something called initial and something called annual. Now, let's talk about them. There are about 4 types of capital allowances. The first one is called investment allowance. What is investment allowance? Investment allowance is the allowance that is only allowed on plant and machinery or plant and equipment. Now, some people, when they see plant and equipment and they now see office equipment, they will say, oh, office equipment is qualified for investment allowance. No, it must go with plants. So it's either you see plant and machinery, or you see plant and equipment, or you just see equipment. If you see equipment, it's assumed that it is plant and equipment. If you see office equipment, that is not plant and equipment. So it's only plant and equipment or plant and machinery that has investment allowance. The rate there is 10%. The rate is 10%. 10% on the cost of the asset. And not only that, if you remove 10%, it does not reduce the value of the asset. It's as good as saying that whenever you invest in plant and machinery, the government is dashing you additional 10% for investing in plant and equipment. It does not affect your tax written down value. It's just like, say, you buy, let's say, what will I use now? Let's say you buy a solar energy and they now give you maybe 7 days credit, additional credit, or you buy, let's say, okay, you pay for DSTV subscription and they now also give you additional maybe 1 week. So this is additional claim that you can have because you are investing in plant and machinery. The next allowance here is the annual allowance. Okay, before I talk about the annual allowance, I will have to talk about the initial allowance. What is the initial allowance? The initial allowance is the first allowance that you are entitled to claim whenever you buy an asset. Let's say, for example, you buy a motor vehicle, not for personal use now, but for business. You are entitled to claim an initial allowance of 50% of the costs. What it means is that government is saying You buy the vehicle for 10 million naira, 5 million will be claimed immediately in that year as initial allowance. So one characteristics is that initial allowance are claimed in the year the asset is first put into business use. Second thing is, it is not prorated. It means even if your account ending is December 31st every year, and you first put the asset into use on December 31st, it means you can claim the whole 50%. That is what it means. Now, when you do that, it will reduce your tax written down value by, let's say if it's motor vehicle, you claim 50%, that means your tax written down value would be 50% immediately in that first year. It is the remainder of that depreciable value or claimable value that is applied on annual allowance. Now let's go to annual allowance. Like the name implies, annual allowance are those allowances you claim every year. Now this is like depreciation. But unlike depreciation, which can be manipulated by management, that is why the tax authority will always disallow depreciation and give you capital allowance. Because let's assume that two companies, the same industry, they bought the same kind of vehicle on the same day with the same amount. And one company is claiming allowance for 5 years. Another one is claiming capital allowance for 3 years. Both of them will have different capital allowance for each year. And so because it is subject to abuse, because one company can decide to use straight line, another one can decide to use reducing balance, another one could be using sum of digits. It is going to be causing frequent distortion. Even at that, you can revalue and maybe extend the life of your assets. You can, because depreciation changes is an estimate. And so all these irregularities that occur with depreciation are not consistent. And so the taxman will tell you, whatever you've done for depreciation, add it back. We will give you capital allowance, which is controlled. And so in capital allowance, annual allowance, you've taken off your initial allowance from the cost. Looking at it from the formula here, cost of the asset minus the initial allowance. What you are left is the depreciable or claimable value, which you will be claiming annually. Now, you will need to know the predetermined number of years. Now, this is what the taxman will give to you. How will you know the predetermined number of years? Now, look at the annual allowance rates. Let's look at it to show you how you can get the predetermined number of years. Let's look at motor vehicle here. Motor vehicle here, annual allowance is 25%. What does it mean? It means if you have an asset and you are collecting 25% of it every year, how many times, how many years will you collect 25% for it to get to 100%? You will collect it 4 times or 4 years. Simply put, if you say 100 divided by 25, you have 4. And so the predetermined number of years is simply calculated by saying 100 divided by the annual allowance rate. And so we say 100 divided by 25, we have 4. So what you now do is your costs minus your initial allowance divided by the predetermined number of years. That is how you calculate your annual allowance. But you see, in annual allowance, you are taking them every year. So for the first year, there is a possibility that you can buy the asset at the beginning of the basis period. That means throughout the whole year, you have been using the assets. That's fine. But there's another possibility that maybe 1 month after the basis period started, or maybe 2 months into the basis period, or 5 months, 6 months, that is when the asset was purchased or put into use. There is a need then for you to prorate the number of months for the first year. And so this M means the number of months the asset has been used in the year divided by 12 full months in a basis period. And so it means that if you use the asset for 6 months, M becomes 6. If you use the asset for 8 months, M becomes 8. So it means that M could be lesser or equal to 12. If you use the asset for full 12 months, M becomes 12. So 12 divided by 12 will give you 1. And that eliminates it. So for the first year, you need to know the number of months that the asset has been put into use and prorate it. For the second year, you know that the asset will be put into full use for the full year. So no need to prorate. So for motor vehicle, you put the asset into use for the first year, you prorate. The second year, you don't prorate. The third year, you don't prorate. And perhaps the fourth year, you don't prorate. Now, for the last year, okay, assuming that the asset has not been disposed, that means after the asset has finished being claimed, for example, that motor vehicle is for 4 years. After the predetermined number of period has elapsed, you can no longer claim capital allowance. So your M now becomes 0. Your M now becomes 0. For motor vehicle from the 5th year, your M becomes 0. So no matter how many months you use it, your M is 0. And 0 divided by anything is 0. 0 multiplied by anything is 0. Your capital allowance, annual allowance, will be 0 from after the full predetermined number of years have elapsed. Now, we go to another type of allowance called the Rural Investment Allowance. This is a relief granted to any company in addition to investment allowance that they have incurred because they provide such facilities as electricity, water, tarred road, and telephone for the purpose of business. And they are located in rural areas that are far away from these kind of facilities. Let's say, for example, Dangote decides to site one of his factory in a very rural area because of the availability to some natural resources that will aid his business and so on. And there is no electricity there, and there is no tar road. He can decide to work with government and say, okay, why don't I provide this facility? And any amount I spend, that's an investment. I'll claim that as rural investment allowance. And so see, look at the rates here that are applicable. Anyway, this rarely comes up in exam, but in case it comes up in exam, please know the rates because they will not be giving you the exam. Maybe the question that will come with it might give you the percentage, but it's good for you to know. Now let's talk about the basis period for capital allowance. Now, normally, capital allowance is claimable from the assessable profit in a year. And so capital allowance will normally follow the same basis period as assessable profit. Okay, it means if your assessable profit is from January to December of a particular year, capital allowance will follow that same basis period. This is because you have to match your claim in the same period with your profit. When we are considering the assessable profits, we came across the 3 C's. I call them the 3 abnormal C's: commencement, change of accounting date, and cessation. We have abnormal period. And so this abnormal period tends to distort the side-by-side movement of capital allowance with assessable profit in terms of basis period. And so with regards to these 3 abnormal period, we're going to look at 2 situations that capital allowances tries to fight or deal with. It is called the overlapping basis period and basis period when there is a gap. Let's look at these 2 situations one at a time. Overlapping basis period. When we say overlapping basis period, it means there are 2 periods common. There is 1 period common in 2 basis period. Okay, let me give you an example. Okay, when we say overlapping, okay, let's give an example like this. When I was writing ICANN exam, let's assume that I started my ICANN exam story, ICANN story. Let's say I started it from 2015, for example, and ended in 2018. Let's say I ended in November 2018. And another person started in 2017 and ended maybe 2019. During those 2 people's ICANN history, there is a period common among them. That period when they will be writing exams together. That means the period of 2018 or 2017 and 2018 is common to both of them. This is what we call overlapping. Okay, so when there are, you can find 1 set of period in 2 basis period, it is called overlapping. We normally see that in commencement rule. Remember, when we are dealing with commencement rule, we say that the first year, let's say the business started January 1, 2010. That would mean that your first year will be from January 1 to December 31st, 2010. Okay, the second year, we also start from January 1 to December 31st, 2010. This is an overlap because the 2 basis periods have certain months in common. Now, in capital allowances say we do not want overlap because overlap will make us charge initial allowances twice, which is a problem. So it means that if you buy an asset during that overlapped period and you want to charge initial allowance, the problem is which of this period will you charge the initial allowance? Will you charge it in the first period or in the second period, or will you say you charge it in both? And that's a problem. The rule here is whenever there is an overlap in basis period between 2 years of assessment, the period common to both of them that is causing that overlap is deemed to belong to the first year of assessment or to the earlier year of assessment. That means if two periods are common, the first time they are occurring, the basis, the year of assessment that has it first when that basis period occur, the first time it's occurring, that is the basis, that is the year of assessment that will take the basis period. If it is being repeated in the second year will say, oh, it has been treated in the first year. And so in the second year, you will not want to deal with that overlap. You keep referring to it that it has been dealt with in the first year. Now that's the rule for overlap. Now, what is a gap? A gap can occur when, normally I said before that a normal basis period is moving like a chain. When one period ends, another period will take the baton from the first period and continue the race. But now, when there is a gap, it means some months will pass before another basis period occur. Now, this usually happens in change of accounting date. Now, how does it happen? Let's say you change your accounting date from a particular month end to another month end. By the time you are transiting to the new accounting date, you find out that there will be a gap from one end to the other. It could be 1 month, it could be 2 months, it could be 11 months, sometimes 15 months. There will be a gap. Now, when there is a gap, what happened? The gap is assumed to belong to the later year. So it means that if there is a gap between the first year basis period with the second year basis period, if there is a gap, an asset was bought in that gap, since it has not been treated in the first year, it will belong to the second year. We also usually experience gap when we are in cessation of business. You know, when you are doing cessation rule, you see, you treat the penultimate year, you treat it using preceding year basis and using actual year basis. Now, assuming that you've qualified the preceding year basis as having the higher assessment, accessible profit, and now you are going to the ultimate year, you find out that there may be a gap of perhaps 1 month, 12 months, 11 months, even 15, 23 months if possible. There may be some gap. What happens to that gap? We usually say that gap will normally have belonged to the later period. But when it comes to the cessation rule, the gap must belong to the penultimate year. So when you are dealing with gap in cessation rule, the gap must belong to the penultimate year. When you are dealing with gap in the change of accounting period, the gap must belong to the later period. If you are dealing with gap in the commencement of business, maybe between the second and the third year, then the gap must form part of the later one. So if there's a gap between year 2 and year 3, the gap must form part of year 3. That's what we are saying. But when we are looking at cessation of business, if there is a gap, you take it to the penultimate year and never to the ultimate year, even though the ultimate year is a later year to the penultimate. Now let's look at restriction on capital allowance. What are the restrictions on capital allowance? I've mentioned this at the beginning, that normally it is 2/3 of accessible profit. What it means is that if you have accessible profit, the law says take 2/3 and use that part to claim your capital allowance. We can take our tax from the remaining 1/3. So I would like you to write it as 2/3, please. And forget about using 66 to third percent. Now, there is a difference between writing it as 66 to third percent and writing it as 66 to third without the percent. If you write 66 2/3 without the percent, you are wrong. But if you write it as 66 to third with the percent, and if you have to break it down, you will get 2/3. Because that percentage is still as multiplying by 100. So it means 200, you'll be getting 200 numerator divided by 300 denominator. And that will give you 2/3. So instead of going through all that process, just simply write 2/3. It's the same thing, nobody will penalize you. Now, this restriction on capital allowance does not affect every company. Now, there are some companies that are into the agricultural businesses or those that are into the manufacturing industry. They are not affected by this restriction. What does it mean? It means if they have capital allowances, they can claim everything using their accessible profit. They will not be restricted to taking 2/3. They can take the whole accessible profit to claim their capital allowance, and no tax will be paid. So this is the enjoyment they get because they are not restricted. Also, we have what we call carry back of capital allowances. Now, whenever there is a cessation of business, that is when the capital allowance carry back can occur. Now, what the government says, the tax authority or the tax law says is that, let's assume that you are being restricted or you are not even restricted. You have huge capital allowance and the accessible profit is not enough for you to claim the capital allowance. What do? You claim whatever you can, and the remainder, you leave it to next year. So you claim whatever you can, and you keep carrying it forward. The next year, you add the capital allowance brought forward from last year and add it to the ones you've had this year to see whether the profit is enough to carry it. And now, because you are making losses, you keep carrying your capital allowance forward indefinitely. You now get to the penultimate year. You've tried, you still make a loss, or perhaps you make small profit, it's not enough to clear it. You now enter the ultimate year. Let's say you made a loss and you cannot clear your capital allowance. What do? The law says that your capital allowance can no longer be carried forward because your business is ending. Then your capital allowance has hit a brick wall. What will it do? It will bounce back. So it will start going backward. So the law says once you get to the ultimate year, you cannot go further. Go back by 5 years. Start counting the backward movement from the penultimate year. So the backward movement will start from penultimate year, that's the first year backward. Then it will go to the year before the penultimate year. You will keep taking it back until you claim it. If you cannot claim it during these 5 years of carrying backward, After the 5th year, anyone that is remaining is deemed to be lost. Now, that's the law of carrying back of capital allowance. And it only happens when you reach the penalty, the ultimate year. What happens to profits or loss when you reach the ultimate year? When you reach the ultimate year, any loss you made cannot be carried forward, neither can it be carried backward. So it is deemed as lost. It is deemed as loss. But the government is so lenient that, oh, you've made a loss, but you still have some capital allowances that you have. All the taxes you've paid in the past, can we refund you your tax and use it to clear your capital allowance? So what the government do is that as you are carrying back your capital allowances, they are refunding you any tax you have paid. They are refunding you any tax you've paid. So use it to clear your capital allowance up to 5 years. Is the government not generous? Yeah. We'll be looking at some examples to see how capital allowances work. We've been talking for almost an hour now, so let's deal with some examples. Okay, example 1. James Nigeria Limited commenced business. So once again, you see the word commence, that's commencement rule. Commenced business as a textile manufacturing company on June 1, 2001, even though it was incorporated in 15th March 2001. The date of incorporation is irrelevant here. What is relevant is the date it commenced business. Its account for the first few years of operation showed the following adjusted profits. Now, if you see here, 10 months period ended in March 31st, 2002. That means this is a period ended, not year ended. You see, it's not full 12 months. Year ended 31st March 2003. Year ended 31st March 2004. Now, for the moment, I am not keenly interested in the figures. The figures will sort themselves out. I am keenly interested in showing you basis period. Okay, you will see from the question here that they only told us when the company commenced business. They didn't tell you when the company account year end is. But you can see it by implication that they are ending their account in 31st March every year. So you don't need to be told. Okay, now the company incurred the following qualifying capital expenditure. Now you see that this one here, March 25, 2001, factory building. What does it tell you? This building was acquired after the incorporation date. You see, they have gotten certificate from CAC March 15, and they went to now buy building 25th of March. The business is still yet to commence. They have bought the factory building in preparation. That's fine. In 18th May, they went to buy machine. Business is starting in June. They went to buy machine. That's fine. These two assets were purchased before the business commenced. How do we treat it? We treat any assets purchased before the business commenced. We treat them as though they were purchased on the first day of the business. And so irrespective of the fact that they were bought in March 25th and May 18, we are going to treat them as if they were bought in June 1. That's the treatment. Now, secondly, look at October 15. The furniture was bought after the business has commenced. That's fine. Then we have February, we have May and January 2003. Now we have office equipment. Note, this is not plant and equipment. So don't come and tell me investment allowance. No. Now, determine the basis period for assessment. And, see this word and is very powerful. Means you have two questions to deal with. One, you are giving me basis period for assessment. That means for profit. And you are giving me basis period for capital allowance for the first 5 years of assessment. Let's do that part first. So let's come now to the solution. Okay, let's go now with the solution for the part A. Now I want to explain the part A for you. The business commenced when? June 1, 2001. So 2001 is our year one. And what did you say is our assessable profit basis period for 2001 to be from the date the business commenced to 31st December 2001. So let's finish with the profits before we go to capital allowance. Second year, it will be from the same 1st of June that the business commenced up to 12 months later. And I told you, in order not to count your finger, if you are standing at the beginning of the basis period, ask yourself, what was yesterday's date? 31st May 2002. So that's how we get this. Now we go to the third year. The third year of assessment. What do you normally do? The third year, you are supposed to use the account ending date, March 31st. So what do? Let's assume that you put March 31st here. Then this is 2003. It means since it is preceding year basis, it must end in 2002. So if this is March 2003, then March 2002, you are standing at the end. You ask yourself, what is tomorrow's date? Tomorrow's date will be April 1. April 1, 2001. If I write April 1, 2001 here, I will be technically correct. But if you look at it factually, the business did not commence. The business did not commence in April, neither in May, but in June. And so you cannot achieve 12 full months using that method. And so if the principle that I taught you for the third year cannot give you 12 full months factually, then all you need to do is repeat the second year basis period for the third year. So simply repeat it. So you see now we have repeated the second year basis period for the third year. This is because we cannot achieve what we want to achieve normally when we do year 3 account. Now it is from year 4 you will start the trick to achieve it. So in year 4, we look at the account ending date. It is going to be March 31st every year. So you look at year 4 is 2004. Somebody is asking a question. Somebody say, please take the year 3 again. I'm taking year 4. The same principle for year 4 is the same principle for year 3. So when I take it, you will see how it's supposed to work. Then I will mention something about year 3. Look at year 4. The account ending date is March 31st. That's the first thing to know. So you start from the end, March 31st. The year of assessment is 2003. If the year is 2003, it means that if you must follow preceding year, 2004 rather, if you must follow preceding year basis, this must be 2003, no doubt. So we have March 31, 2003 as the ending date. Now, you ask yourself, if you are standing at the end and you want to get the beginning, you ask, what is tomorrow's date? Tomorrow's date is April 1. April 1 now, 2002. If you cannot remember all this, you feel free to count your fingers. I'm not stopping you from counting your fingers, so count 12 months back. Now, this is what we try to achieve in year 3. This is what we try to achieve in year 3. When we said March 31st, 2002, we are supposed to get April 1, 2001. But we said as at 2001 April, the business has not started. So why go and write April when it has not started? But if you go and write June 1 to March 31st, you cannot get full 12 months. But in the third year, you must have 12 months. If you cannot achieve full 12 months, always repeat the year 2 basis period for the year 3 basis period. That's it. The only reason why we are repeating year 2 for year 3 is because we cannot apply April 1, 2001 to March 31st, 2002 because April, the business has not started. And we cannot say June 1 to April to March 31st. You will not give us full 12 months. So you simply take year 2 and put it in year 3. Then that thing we try to achieve in year 3 that didn't work, it is in year 4 we have to do it, which we've done, and it's working. For year 5, which is 2005, you don't need to start doing any story. All you need to do is, can you see when this one ends? March 31st, 2003. Ask yourself, what is tomorrow's date? Simple. April 1, 2003. When will it end? March 31st, 2004. So all you need to do is, you just copy here to this same 2004, 2005. You just increase the year by 1. Increase the year by 1. So that is how you'll be doing it. For 2006, you still copy this down there, increase the year by 1. So it means that this is a normal basis period. So 2004, 2001 is not a normal basis period. 2002 is not. 2003 is not. 2004 is also not, because it didn't continue from where 2003 stopped. There is a gap. Okay, no, there is an overlap. There's an overlap. But 2005 is a perfect normal basis period, because 1, it is 12 full months. 2, it is on preceding year basis. And 3, it started where the last basis period ended. Now we have done with profit basis period. Let's move to capital allowance. Whenever you are starting your business, your capital allowance for the first year will be exactly the same as that of profit. So that's our base. So your profit is from June 1, 2001 to December 31st, 2001. So be it. Capital allowance is the same. Now, in the second year, there is an overlap between the first year and the second year. What is that period that is inside here, that is in 2001, that is inside here? we can find June 1 to December 31st inside of here. So what do you normally do? I will give you a very simple formula to follow. When you've done the first year and you want to go to the second year, what do? When you look at this first year, this first basis period, you ask yourself, can I find June 1 inside here? Yes. If I can find June 1 inside here, that means June 1 is not qualified to be here because there is an overlap. The next thing you look at again is this. Look at this ending date. Can I find May 31st, 2002 in this 2001 basis period? No. If you cannot find it, it means it qualifies. So you deal with it first. So you see here, this qualifies. You put it simple here, it qualifies. So it means what will be here? So if you look at it here, this one does not qualify. So if this one does not qualify, you look at the ending date of the first capital allowance and say, what is tomorrow's date? Tomorrow's date is January 1, 2002. And that is what you will put here as the beginning of the basis period. Note, this basis period that starts from January 1 is still the same thing. It's still starting from June 1, 2001. Yes, it is still starting there. But the thing is, any assets bought within the overlapped period will not be treated again. So it is only taking a unique date that is not found in the first period to treat only the initial allowance. So your initial allowance will take from assets bought in January 1, 2002 to May 31st, 2002. Because there is no overlap and there is no gap. So you can see here that where the first capital allowance period ends, that is when the second one starts the next day after. And you see it ends where the profit ends. So that is how you treat it. So look at the third year. Did you notice that this third year is an exact repetition of the second year, and it's an exact overlap? And so you see there is a dash. It means there is no basis period. It means everything in the third year would have been treated in the second year. Now let's look at the fourth year. We start here with April 1, 2002. Can we find April here? Even if you look at it from the capital allowance point of view, you take this April 1, 2002. Can you find it here? Yes, you can. So it doesn't qualify. You can even find it in the former one, so it doesn't qualify. You take the last one. Can you find this March 31st, 2003 anywhere here? No. If you can't, it qualifies to end. So what would be the beginning? Simply look here and say, what's tomorrow's date? Tomorrow's date is June 1, 2002. So that's June 1 to March 31st, 2023. Now let's look at the fifth year. This April 1, 2003. Can you find it anywhere here? No. Moreover, it is not a gap. So it is not a gap. So if you cannot find it, look at it again carefully. Is it the next date after the last basis period? Yes, it is the next date, so it qualifies. And so if this first one qualifies, once the first date qualifies, the last must also qualify with it. It is when the first date is not qualifying, you choose the last date, you check the last date. If it qualifies, then you choose a date. So, you know, the capital allowance will always give the baton to the next one. So you see there is no gap. Where this one stops, the next day the other one starts. Where this one stops, the next day the other one starts. Where this one stops, the next day the other one starts. That is how capital allowance work. There is no overlap and there is no gap. Now let's look at the assets. Okay, so we see here that we said factory building and machinery will be treated as though they were bought in June 1, 2001. So if you look at it, there's June 1, 2001. So we treat the factory building and the machinery. Since it ends in 31st December 2001, all the assets bought in 2001 will be treated. So this furniture that was bought in October will be treated. So that's what we find here. Now we'll go to the second one. We'll be looking at this capital allowance basis period. Now, any asset you bought from January 1, 2002 down to May 2002 will be treated. So let's check. Yes, this is February and this is May. So we look at motor van, motor vehicle and delivery van. These are the two items that are treated here. Now in the third year, there is a dash. So if there is a dash, nothing is here. In the fourth year, we look at June 2002 down to March 2003. June 2002 to March 2003. This one is January 2003, so it qualifies. So you see office equipment qualifies. Then here is April 2003 to March 2004. No asset was bought in April nor further. So there's a dash there. Okay, so that is how we answer the first part of the question. We've treated the basis period for profit. So this is a fine way to revise your basis period for profit. And we've seen how basis period for capital allowance normally followed out of profit, but it will prevent overlap and prevent gap. Thank God for this new Finance Act 2019. There will be no more overlaps or gaps in basis period. And so during commencement rule, you will not be seeing these kind of things anymore. Capital allowance will just normally work with that of the profit. Let's get to the second part of the question, the B part. We said compute the capital allowances due for 5 years of assessment in respect of the qualifying capital expenditure incurred by the company. We're asked to compute the capital allowances. So sorry for the break in transmission. So sorry. We are now in the B part of the question. Compute the capital allowances due for 5 years of assessment in respect to the qualifying capital expenditure incurred by the company. So what do we do there? We bring our year of assessment. We know it's from 1, 2, 3, 4, 5, 2005. We bring the basis period for capital allowances, which we have already done. And so what do we do? What do we do? The first one is we bring, so this column 1, column 2, column 3 is taken from the previous table. Now we are adding initial allowance, we are adding annual allowance to it, and we are adding total capital allowance to it. So this is the final part that we are asked to find, the capital allowance. So how do we get all of these figures here? Because it looks kind of confusing. How do we get these figures? Now I'll show you how we do it to get the workings. Okay, so I will need to open another material for workings. Okay, I will need to, okay, let me take this on to page 7. Fine. So now this is our solution. So I'll take this one to the workings. So look at our workings. The first working here is for initial allowance. How do we calculate initial allowance? The first one is factory building. And how much was our factory building? Our factory building was 3,500. And so we say initial allowance is 15%. If you remember our table, I think I will need to open our table. I will need to open one more for table so that we'll get our table of capital allowances. Okay, so let me bring this one for tables. So let's take it now. Good. So let me keep here for tables. So we said factory building. So where is factory building? That's it here, industry buildings. And we have here 15% initial allowance. So that's what we did here, 15% of 3,500,000. That's simply going to give us 525,000. And that's the 525,000 we had here. Okay, now the next one is machinery. What do we do? Machinery. Okay, plant and machinery, 50%. 50%. So we have it here, 50% of how much did he buy it? We bought it at 2.8 million. So that's what we did here. 50% of 2.8 million give you 1.4 million. And the third one was furniture. And we got 187. How did we get it? Furniture and fittings. Furniture and fittings is 25%. And so we have it here, 25% of the cost, 750, you have your 187,500. So that's your total initial allowance. When you add this first one to the second to the third one, you are having 2,112,000. This is your total initial allowance for the first year. Now, how do we get our annual allowance? Look at the way we calculate our annual allowance. We come for 2001, we have our annual allowance figure for factory building. What's our annual allowance rate? Factory building is industry building. We have 10%. What does 10% tells us? We simply do 100 divided by 10. 100 divided by annual allowance rate. So 100 divided by 10 is 10 years. So simply here we do 100 divided by 10, which is 10 years. So it simply means that this is your cost. This was your initial allowance, which we calculated here. This is the initial allowance. When you minus it, let me get a calculator and be doing it straight. Okay, I'm back. So initial allowance 3,500,000. Okay. Now you less 525,000. What you'll be having is 2,975,000. When you divide it by 10, divide by 10, you have 297,500. And now that is your full annual allowance. That is what you are supposed to be charging every year as your full annual allowance. Take note, we'll come back to that figure. But because this is the first year, and how many months is this asset being put into use? You check again, this is from June 1 to 31st December. How many months is that? It's 7 months. So what do? We bring this our full annual allowance here and prorate it for 7 months out of 12. That means we have used this formula. We've used the, sorry, where is that again? We've used our M over 12 formula. So this M is 7 over 12. When we do that by saying times 7 divided by 12, we have 173,542. That will be the annual allowance for the first year. Mind you, for the second year, we are going to use this. For the third year, we are going to use this. For the fourth year up to the 10th year, we are going to be using this. But for the first year alone, you have prorated it to this. So that's the trick. The first year, you prorate. Second year, you come back and use the full value. Now, that's why we have this figure here. So this one belongs to factory building. Now let's look at the second year, the second asset, which is machinery. The cost is 2.8 million. We've already charged 1.4 as initial allowance. And how much is machinery? I think it should be 25%. Yes, I have it here, 25%. So what do we do when it is 25%? We say 100 over 25, and that will give us 4. So we have 2.8 minus 1.4 will give you 1.4. Divide by 4 years. That will give you 350,000 naira. Now, because we are also going to prorate for 7 months, we are going to say times 7 over 12. That will give me 204,167. And that's how we got it here. The same thing applies to the furniture. When we remove the cost minus the initial allowance, and we get our predetermined number of years, 100 divided by 20, which will give you 5. So when you minus and divide by 5, you're having your full annual allowance of 112,500, and you prorate by how many months? 3 months. How did we get the 3 months? This was bought when? In October. And so we have October, November, December, and that's the 3 months we are looking at. So is that 3 months? That is 3 over 12. That gives us 28,125. So we see it here. When you add all your annual allowances figure, you are getting 405,834. Then you add your initial allowance for that year to your annual allowance to give you your total allowances here. So that's how you get the capital allowance for the first year. Let's go to the second year. The second year, we are dealing with delivery van and motor vehicle. These are the assets that we have bought that year. And so they qualify for initial allowance. Don't you think so? So if you look at the table, both motor vehicle, motor van, and delivery van are all motor vehicle. So initial allowance is 50%, annual allowance is 25%. So let's do that quickly. We'll come to 2002. Delivery van is 50%. How much did we buy it? 500,000. So it's confirmed here. 500,000 was how much we bought it. This other one was 1.2 million. So we come and 500,000 times 50% will give you 250. So that's the 250. The other one is 1.2, 50% will give you 600. So that's the 250 and the 600 we have here. When we add them together, we are getting 850 as our total initial allowance. Now let's go to annual allowance. For the second year, so let's shift this thing down a bit. For the second year, this is your cost for delivery van. This is the initial allowance, and annual allowance, we said it was 25%. So it's 100 over 25, which is 4 years. When you do it, you are getting 62,500. That is your full allowance for the year. But since this is the first year, you are using the delivery van for the business. So you have to prorate it. For how many months in the basis period? You bought your delivery van when? You bought it in February. So if you bought it in February and the basis period is ending in when? In May. So you February, March, April, and May. That's 4 months. So you're going to prorate it 4 out of 12. When you do that, that means you have 20,833. Okay. Now you do similar thing for motor vehicle. This is the initial allowance. This is the annual allowance. Cost minus initial allowance. You divide by 4 years. You are getting 150, and now you prorate it by 1 month out of 12, because this motor vehicle was bought in May. Was bought in May, and the basis period is ending in May. So you are prorating by 1 month. So you take 12,500. So when you look at it, you have, this is for delivery van, and this is for motor car. So, but what is this 760,000 naira doing here? Okay, let me explain. Remember, you had factory building from last year, machinery from last year, and furniture and fittings from last year. So what do? We bring their full annual allowances now. So let's calculate together. We have this 297, 500. You now add it to this 350,000. Add to 350,000. You now add to this 112,500. 112,500. That gives you the 760 that we are talking about. So this is old assets. Assets bought in 2001. Their annual allowance is 760. So when you add 760 to these other two new annual allowance you brought for this year, you have 793,333. Add it to this initial allowance, you're having a capital allowance of 1,643,333. And that's fine. We'll go to year 3, which is 2003, and we have no basis period. What does it mean? No asset was being considered here. No asset was bought. Why are we having no basis period here? Because there is an overlap between the year 2 and year 3, which we said before, and we've treated everything in year 2. And so even the delivery car and the motor van that was bought has already been treated in year 2. So we will not treat initial allowance again. But when it comes to annual allowance, you must treat it. So how do we treat it? Now, can you see that we already have factory building still existing, machinery still existing, furniture still existing, and they cost us 760. Now, in 2003, your motor van is going to be charged full. So we are going to take this 62,500 to add to that 760, 62,500. Then we'll add motor car 150, 150,000. What we have here is 972,500. So that's what we have here as our annual allowance, 972,500. Since there is no initial allowance, our annual allowance is 972,500 plus 0 initial allowance. Everything gives you 972,500. Okay? Now, we go to the next year. The next year is 2004. All right? We bought office equipment in January. So let's look at the computation of the initial allowance. We go up here. The office equipment is 50%. You see it here. Office equipment, 50% initial allowance, 25% annual. So we go here. Office equipment. We see it here, 50% of 600,000. That gives you 300,000. Now that's how we got the 300,000 initial allowance here. Okay, let's look at the annual allowance. Annual allowance for 2004. Let's see. Annual allowance for 2004. So equipment, 600 cost, 300 initial allowance, 4 years in use gives you 75,000. You prorate it for 3 months because it was bought in January. So it is used January, February, March. March, the business period ended. So use it for 3 months out of 12, you have 18,750. And that's what you have here, 18,750. What is this 972,500 doing here? It is this same 972,500 for all other assets, factory building, machinery, furniture, delivery van, motor vehicle, all of them are coming here. Okay? Now we'll go to the last year, which is in 2005. In 2005, we did not buy any assets, and so there will be no initial allowance. But what will happen to the annual allowance? What will happen to the annual allowance? For asset purchased in 2001, calculated 760. For asset purchased in 2002, calculated 212. For asset purchased in 2004, you put the full value of 75. You add them up together, you have your 1,047,500. That's your annual allowance for the last year. So that becomes the total annual allowance here. Okay, so now that we've answered that part of the question is now saying in part C, compute the company's tax liability for the first 5 years of assessment. Now, the company's tax liability for the first 5 years. Look at what we are going to do now. Do you remember this table? We are now calculating tax, and tax is based on assessable profit basis period. So temporarily we will not be looking at basis period for capital allowance anymore, because we have attached capital allowance figures from our last calculation to the year of assessment. So capital allowance in questions are always given to you attached to year of assessment. So we have, for each year of assessment, we already have capital allowances. Now we are dealing with profits. We'll be taking the profit basis period. And so look at what we are going to do now. We are going to go to the part C, and let's look at it. In part C, what's our basis period here? June 1, 2001 to 31st December 2001. And that's what we have here. What's our basis period? And what's our assessable profit from June 1? So we have 75, and this is for 10 months. And your 10 months is ending in March 31st. How many months do we need in our basis period? How many months is here? June to December is 7 months. So that means we need 7 months out of the 10 months. So this 75 is for 10 months period. So we need 7 over 10 of it. And that will give us this 6,297,500. Then our capital allowance. What is our capital allowance here? We've calculated it before. So let me just bring this one to show our capital allowance that we've calculated before. So let me just bring this to keep our capital allowances. So you'll be seeing the figures where I'm taking them from. Okay. Now, this company, James Nigerian Limited, is a textile manufacturing company, and there is no restriction on this capital allowance. And so you won't be seeing me doing 2/3 over 3. You won't be seeing me do 2 over 3. So you see here, your capital allowance is this full value. That is what you are taking here. So no restriction. So you less it from 6,297,500, and this is what you have as your taxable profit. So what do? You find 30% of your taxable profit. That gives me this as my CIT. 2% of your assessable profits. That gives me 125,950. That's my education tax. And that's all for the first year. For the second year, what's our basis period for the second year? Is from June 1 to May 2002. So we are giving up to March 2002. and we start from the same date the business started. And we need 12 months, and this is a 10 months figure. So it means we are going to take this full 10 months figure, and we are going to take 2/12 of this figure to complete. So that's what we did here. This is the 10 months figure, and this is 2/12 of that other figure I told you about. So that will give you 2,000 plus 7.5, give you 9.5. Now, capital allowance. The capital allowance is this figure here, and that's what I took here. Capital allowance is this figure. When you less it from your accessible profit, you have your taxable profit here. It is from this you find 30% of it, and you get this figure. Then go back to your accessible profit and look for 2% of it. You have your education tax. So simple. When you add these two taxes together, you have this figure. So simple for year 2. We move to year 3 and we do similar things. What is our basis period for year 3? If you remember, year 3 was a repetition of year 2 basis period. And so if it's a repetition, it means the accessible profit will be exactly the same thing we calculated, 9.5 million. But what about our capital allowance? They will not be the same because we are not doing overlap or gap. We have a capital allowance figure, which we have for that year 2003. We have it here, 972,500. That's what we are going to use here, and that's what we've done. Less it from here, you have your taxable profit from which we base our company income tax, and our accessible profit was that where we base our education tax. We take 2% of it. We now move to year 4. In year 4, we have this is our basis period from April 1, 2002 to March 2003. We are given April to March. We are given, so no need doing any workings. We were given. Since we are given, we take the 112 million here, and that's what we did. Take the 12 million, and we take our capital allowance, and less it from 12 million, we have a 10.7808 million. Now, this is from there we base our CIT. Also, we do our calculation of education tax. Now, let's get to year 5. In year 5, our basis period is based on this. We were giving it straight ahead. So we take our 18 million. So our 18 million is being taken here. Capital allowance is calculated here. We put that into the equation, and we have 16,952,500. We do our income taxes and education tax. So simple. So I want you to look over these questions again and see how you can understand it. See how we can understand it. Now, I want you to do as an exercise for me, although the solution is there already, but I want you to understand. I will not be solving this particular question directly, but I'll be explaining certain things that will help you to understand the answers. Now, this is Energy Resources Limited. It's a company engaged in the incorporation and sale of new electric cookers. So, one, you've seen the name of the company. You have looked at the nature of the business. Why are you looking at the nature of the business? You are looking at that because you want to know if you are going to prorate the accessible profit as to third to get capital allowance. Now, this company is not engaged in manufacturing, neither is it engaged in somebody is asking me, how did I compute the capital allowance for year 3? And we arrive at 972,500. The scene is there already now. There is the computation there. There is the computation here for 2003. Look at it here. Look at it here. Assets purchased in 2001 will bring their full annual allowances. If you add them up, it gives you 760. Assets purchased in 2002. If you add their full annual allowances, it gives you this. And when you add the two of them together, it gives you 972,500. So that's what we did to get the 972,500. That being said, let's go back. This company is not into agriculture, neither is it into manufacturing. So when you deduce that, just write in the corner of your paper, capital allowance to third of accessible profit. Now that's one hint I've given you because you are going to look at the solution yourself. Now, secondly, the company is ceasing business in 2018. 2008. The company is ceasing business in 31st July 2008. What does that mean? It means that if there is unutilized capital allowance on the ultimate year, it means that you need to carry it backward for 5 years, beginning from the penultimate year. Now, that's where I am going to. So that's where I'm going to. So I'll show you how you carry back your capital allowance. So I'm going to jump certain things, which to me now is an assumed knowledge from exercise 1 I did for you. Secondly, okay, we talked second one. The third thing here is look at your accessible profits given to you here. And you are given year ended. Anytime you see year ended, that is basis period. Now, I want you to convert basis period to assessment year. So it means year ended 30th September 2000. What is going to be your year of assessment? You simply come here and put, so I would just want you to write under here, YOA. Under here, you put 2001 beside 2000. So it means your year of assessment is 2001, but the basis period is ending September 30th, 2000. Ending September 30th, 2001, your year of assessment will be 2002. So I want you to do it that way until you get to 2008. So that's for profits. And I told you, look at the 10 months, look at when it's ending, 31st July 2008. And they told you also in the question. I also told you that in capital allowances, they will never give you capital allowance and be telling you year ended. It's always tagged to year of assessment. It's always tagged to year of assessment. So the capital allowance, there's no adjustment. This is the year of assessment, 2001. We need it up to 2007. It's been given to you. Use it as given. But you have to convert year ended, you put by the side year of assessment and try to see. So that the reason why I'm asking you to write it by the side, so that as you are looking at year of assessment, you will know the profit figures you are taking. So that by the time I say year of assessment 2001, you'll not be looking at year ended 2001. No, you'll be looking at year ended 2000 because it's going to be preceding year basis. Now being said, we said balancing allowance. That's another type of allowance which we didn't discuss. Balancing allowance is an allowance that you get after disposing of your capital, qualifying capital expenditure. Now, why is it called balancing allowance? Let's assume that I have motor vehicle which I bought for 10 million naira. 10 million naira, and I've claimed 5 million, 50% as initial allowance. I have 4 years to spend the remaining 5 million. So 4 years divided, 5 million divided by 4 is 1,250,000. Let's say I bought the motor vehicle at the beginning of the basis period, and my basis period for each year is full 12 months. It means that 5 million, I have for the first year, I will remove 1.25, 1,250,000. It will be left with 3,750,000. The second year, I remove 1,250,000. It will be left with 2.5 million. Now, assuming after the end of the second year, I sell the assets. If I sell the asset for 2 million, I have lost 500,000. It means that if I had not sold the asset, eventually I will finally claim the whole 2,500,000. But because I have sold the asset for 2 million, that is only what I have realized. What happened to the 500 loss I made? The government is going to ask you to claim it as a balancing allowance. So that is the balance the government is supposed to give you. By taking 2 million, it means you have realized 2 million out of the 2.5. The remaining 500 is a balancing allowance, which is normally added to your capital allowance. Okay, now you have 2.5 million. Assuming you sold the assets for 2.8 million, the government will say, you have realized your whole 2.5 million and you've made an extra profit of 300,000. That's 300,000 extra. The authorities see it as balancing charge. It means you've made additional profit. We are going to tax you on that extra 300,000. So it is usually added to your other income. Balancing charge is added to your other income so that you can be charged tax. So you cannot be making gain from assets that you bought that the government is giving you allowances. Neither will you make loss on them. That's why you are having balancing allowance. So now this question says you have a balancing allowance for that year when you dispose of your asset because you have ceased business amounting to 2,350,000. In this question, there's going to be, let me fast forward to the question to the last side, solution. In the penultimate year, the ultimate year, you have an unrelieved capital allowance. You have, okay, let's look at penultimate year. Okay, let's look at the penultimate year and ultimate year as an illustration. Now, in penultimate year, you have accessible profits of 950,000. You study the answer, you will know why you got 950,000. Let me show you straight. The penultimate year is the year, the basis period is ending in September 30th, 2006. September 30th, 2006. Where are you? September 30th, 2006. So that's 2007 year of assessment. Is this 950 we are talking about? Now, we are not looking at actual year basis. We look at January 1 to December 31st. So you ask yourself, where can I find January 1, 2007 account? You can find it here. You find January 1, 2007. So this account would have started from October 1, 26 to September 30th, 27. So from January 1 to September is 9 months. So we are taking 9 months here out of 12. That's what we did here, 9 months out of 12. And the remaining 3 months is taken out of this remaining 10 months. So it's going to be 3/10. When you add them up, it gives you 660. This is actual year basis. This is preceding year basis. The tax authority will ask you to choose the higher one. Choosing the higher one. Now look at our capital allowance. Capital allowance for the year happened to be 950,000. Now, we said this company is not into agriculture or manufacturing. So we are doing 2/3. So you're going to check 2/3 of 950. 2/3 of 950 will give you 633,333. This is the amount of capital allowance that will be relieved. Mind you, that I'm writing it 2 times. I will tell you the reason why I'm writing it 2 times. Under this first year, the reason why I'm writing it here is that if I less it from the capital allowance I have claimable, if I remove it from the capital allowance I have claimed, this is the capital allowance that will be carried to the next year. So I want to, for putting it here first time, I want to know the balance of my capital allowance I will take to next year. By putting it here in the second place is where I am actually using it against the profits. So look at your assessable profit, look at your capital allowance that you are claiming. So when you remove it from your profit, this is the remainder that is to be taxed. Here, this is the remainder of capital allowance you will take to next year. Yeah, this is the remainder of your profit after you have claimed your capital allowance. And now you claim income tax of 30%, claim your education tax, then you go to the next year. The next year is the ultimate year, and we do our profits, actual year basis. You got this. Now, this is your capital allowance. This one here that you take to next year, you are bringing it forward here. Now, this is the balancing charge, no, balancing allowance that you are supposed to claim after you sold all your assets. When you add them up together, you have this figure. But look at it now. You cannot, this is the ultimate year. Now, in the ultimate year, you cannot be affording to do 2/3 anymore. This is the business has ended. You are trying to recoup all your capital allowance as much as possible. So in the ultimate year, you will take the whole profit and you recoup it from your capital allowance. So look at it now. This profit figure is what I'm putting here as my capital allowance to be relieved. I'm not doing 2/3. I'm putting it here, I'm putting it here. It means here that this is the capital allowance that should have been carried forward. I mean, assuming business was continuing, but now we are carrying it backward. You see, there is no taxable profit, and so you are not supposed to pay tax in the ultimate year when you have capital allowance still outstanding. but you still pay your education tax, nothing spoiled. Now, you are taking this backward to your penultimate year. So what do? I'm bringing back my penultimate year. Now, this was your taxable profit. This was your taxable profit brought backward. Now, this taxable profit was the profit you had before you paid tax. Let me bring it and show it to you here. For the penultimate year, okay, now, this was your taxable profit after you have claimed all the capital allowance for that year. It is that same taxable profit I am bringing down here. Why am I bringing it down? I'm saying I have more capital allowance to be claimed, though. You've claimed the first one and you got to this point. I have more capital allowance I want to claim. Don't take tax yet. I have more capital allowance to claim. Now look at your capital allowance brought backward. It is bigger than your profit, your taxable profit. So you are going to bring all these taxable profits to claim them. So you are claiming it here, you're also claiming it here, you're writing it twice. The essence here is to get your taxable profit as zero. And this is what you are taking backward. Now, because you have your taxable profit as zero, any tax you've paid before will be refunded to you. So this 95,000 will be refunded to you. So it means that the tax of 95,000 previously paid would have been refunded. Now you are going to the next year before the penultimate year. You have 470 as your taxable profit. You are bringing this one down here to be relieved. So that's how you'll be doing it until you get to the last year. So this is the final year that the tax is going to be carried backward. So the final year, look at the profit, taxable profit we had, look at the capital allowance that was brought backward, and funny enough, good thing, the taxable profit is bigger than the capital allowance. So you can claim all the capital allowance, claim all the capital allowance. No capital allowance to be carried backward. You have fully claimed them. Now look at your new taxable profit. Your new taxable profit is no longer this. If I take it back to 2003, you observe what is happening here. Now, look at your taxable profit here, and you paid a tax of 604. But now, your taxable profit has reduced by way of after claiming this capital allowance to this, and you're now supposed to pay a tax of 536,500. So they will do a trade-off. You have paid 604, but you're supposed to pay 536. So they are going to give you the balance of 65,700. So that's what you are going to pay. So look at your summary of tax now. In 2001, you would have paid this. 2002, this. 2003 is this difference. Is this 538, 536, 500 that you are paying. From 2004 down to 28, we are paying no tax. All the taxes you paid in 24, 25, 26, 27 would have been reviewed and given to you. Now, study a similar example in 2018, 2015 past question. This skills past question paper, skills level past question paper. Go and get this question number 1 and study it. That will help you very well in learning capital allowance carried backward. So far, so good. We've done part 2 of our tax, of our business tax. In the next class, we are going to briefly touch part 3. We're going to briefly touch part 3, then we enter into something else. Our time is well spent. I will take no question, but bring the questions in the WhatsApp class, the WhatsApp group. I'll be glad to take them. Thank you so much for making the class a successful one. We'll see you in the next class. I'll be waiting to take your question. Have a nice day.